Jeff, can I pick up at you? You write a cracking paper on 10 key questions for the market, and you say, is it time to underweight equities? Now, you as a house have tactically gone underweight equities, but I look at the yield differential between bonds and equities, and it's still quite a considerable, I suppose, margin of stocks over bonds. When you go to tactical underweight, how does that play out?
Well, it really depends on, where we do see the, where the bulk of the underweight is happening. So, for example, Europe is right now our biggest underweight. In the US, we're actually a bit less concerned about at this point. So you really got to, in the context of the trade issues of global growth, you want to identify the high beta markets, to a downturn in global growth. And right there, emerging markets and the Eurozone, for example, maybe suffering a bit more. So, that's where we would want to, give a bit of a tilt towards our underweight. But as you say, the difference is marginal right now, and do you want to make an argument that it's bonds which are relatively overvalued, especially long dated yields? That's where we need to be a bit more cautious as well. Net though, we want to stress, even though we're underweight equities, there's no global recession, well, at least not according to our base case. But again, let's see where the US consumer goes. That's key right now.
Yeah, I mean that is going to be the driver of everything. Now, when it comes to gold, we see the PBOC, interesting, we wrote a piece this morning on Top Gold, PBOC buying gold for the 10th month in a row. You talk about the relationship between gold and the dollar. Dollar positioning is at the highest in 2 years. Dollar is just skimming off the 100 level on the DXY. So there is this kind of momentum behind gold. Where does it play for you?
Well, two things really. Firstly, you're going back to China's monthly gold reserves. It's good that they're updating their data a bit more regularly, as your chart showed. They've gone from one every 3 years to a higher frequency. But secondly, I think it's an acknowledgement as far as gold and other real assets are concerned. If real rates are going to be kept low, either due to nominal bond yields low and/or inflation expectations may be picking up further down the line, especially if monetary policy works, then that's an environment that's good for gold. Where we might push back a bit against, some client views as, if something goes wrong in terms of geopolitics and the like, safe haven trade, I want to rush to gold. Yes, there's a short-term reaction to that, but you don't want to, base your entire asset allocation on a collection of or a collective of risk aversion events, right? So we need to identify why you want to own gold, and if it's a real rate story, if it's a dollar story, then that is conducive to gold in the short term.